When you invest offshore for a golden visa, you are stepping into a dual compliance zone. Unlike most countries, the US taxes its taxpayers on worldwide income, no matter where they live or invest. This means you must navigate both the tax laws of the foreign country and the complex additional reporting obligations of the United States. The Golden Visa program in Portugal offers a unique benefit. It separates legal residency from tax residency. As long as you don't live there full time, you can enjoy temporary legal residency rights and even tax-free gains on your Golden Visa fund investment in Portugal. However, you will still owe taxes to the US, and those taxes could be high. So, what are the key tax risks that could trigger IRS penalties if you're not careful? There are three main areas to be aware of: PFIC, Passive Foreign Investment Company, CFC, Controlled Foreign Corporation, and FBAR and FATCA reporting. First, let's talk about PFIC rules. Congress created these laws to prevent Americans from deferring taxes on passive foreign investments. A foreign fund is considered a passive foreign investment company, PFIC, if a significant portion of its income or assets are passive, such as dividends or interest. And virtually every Golden Visa fund that I know of is classified as a PFIC under US tax law. Without careful planning, this classification can impose punitive tax rates on your fund income and capital gains. Currently, it's set to match the highest personal income tax rate, which is 37%. Mitigating that requires proactive elections for alternative tax treatment and complex annual reporting. That reporting relies on information furnished by the fund so that you, as a U.S. investor, can calculate your tax impact. Note here that this is entirely reliant upon the fund furnishing a PFIC annual statement, and that most funds promise this, but few funds legally obligate themselves to do so. What's more, those statements, when provided, are typically issued in early April. In Portugal, tax returns are due in June. In the US, of course, they're due on April 15th, unless an extension is filed. The funds issue paperwork on their own timeline, not on a US investor's timeline. Most investors should expect to file extensions every year for their own tax returns in the US, so that they have time to incorporate the PFIC annual statement information into their returns. PFIC rules affect how your investment's income and gains are treated. Paying phantom income tax on fund income is a common requirement for PFIC investments. That's when you're required to pay US taxes on the value increase in the fund, even if the fund hasn't distributed any cash to investors. These are all important considerations for your overall investment and exit strategies. We touch on these in my videos, including the Golden Visa exit strategy, getting your money back. Next, you need to understand CFC rules, or Controlled Foreign Corporation rules. This is where it gets more complex. While a single investor is not likely to own enough of a large fund to be subject to these rules, the laws look at the collective ownership of all U.S. investors. A foreign fund can be deemed a CFC if U.S. shareholders each own at least 10% of the fund, collectively own more than 50% of the fund's voting power or value. This can also be true for companies that the fund owns if the thresholds are met. While Golden Visa investors can be relatively sure that the funds are PFICs, it's less likely that controlled foreign corporations come into play, but they could, so it's good to be sure. Finally, there's FBAR and FATCA reporting. The Foreign Account Tax Compliance Act and Foreign Bank Account Report are strict U.S. laws that require you to report foreign financial accounts and assets to the IRS. Failure to report these can lead to steep penalties. Beyond these rules, a significant risk that most foreign advisors don't understand is the legal mismatch between the U.S. and Portugal. Portugal operates under a civil law system that does not recognize U.S. legal structures like trusts and IRAs. This can lead to your investment being titled incorrectly, which could trigger a prohibited transaction under U.S. law and result in your retirement account being fully taxed with a substantial penalty. Please be very dubious of any fund that advertises that you can invest with your U.S. IRA. Beyond the self-benefit prohibition of using IRA capital for a personal benefit, such as access to the Golden Visa program, there are multiple self-dealing traps that can lead to breathtaking tax consequences for Americans. Understanding these core tax concepts is a crucial first step to protecting your investment. You must ask the right questions about the fund's structure, its U.S. tax classification, and its compliance. For a more detailed look at specific tax forms that you need to file and how to navigate this reporting, see my video on navigating U.S. tax reporting with a Golden Visa investment. For a full education on how to identify and avoid these tax traps, I welcome you to join the Don't Get Burned Golden Visa Risk Masterclass.